Good day friends, welcome you all in this lecture. Friends, we are talking about risk and return of any investment. In my previous lecture on this, we have discussed how we calculate risk. I'll take few more examples of calculation of risk and will show with the taking by different examples that how we measure the risk of an investment. As you know that risk and return go hand in hand. Wherever you make an investment, every investment is subject to risk. Risk is associated with it. And every investor is risk averse. He wants to avoid the risk. He wants to minimize the risk. So, while making any investment, you must know what is the risk associated with this investment. So, while investing scientifically, you must calculate the amount of risk involved in it. So, we are discussing measurement of risk. Let me take an example. I am continuing with the previous examples, right? So, I am taking one more example of calculation of risk, that how we calculate risk. The rate of return of security ABC Limited and XYZ Limited in different market conditions is as follows. That is, there are two investments, that is investment in ABC Limited and investment in XYZ Limited. I am talking of investment of equity shares, right? So, an investor wants to invest in the equity of, in the shares of ABC Limited and XYZ Limited. And there can be three different market scenarios after a period of time, say after an year. There can be bearish condition. Bearish condition, as you know, bearish means the market will be sluggish, market will be down, right? So, when there is a bearish condition, you expect to get lesser return. There will be normal conditions, means market will be normal, so you expect normal return. And there can be bullish condition. Bullish is the condition where the market is booming, prices are going up, share prices are going up, right? So, that condition is called bullish condition. So, there can be three different scenarios in a market. That is, market will be either bearish, the market may be normal, market may be bullish. So, probability assigned in our example, probability, an investor has assigned the probability that what will be the probability that the market will be bearish, 30% probability. What will be the probability that the market will be normal, 30% probability. What is the probability that the market will be bullish, 40%. Means there is a greater chance that the market will be bullish, the share prices will be going up. So, there is a bullish condition in the market, the probability of it is 40%. And the rate of return of the two securities in all these three different scenarios, bearish, normal and bullish, is given. That if there is a bearish condition, 15% return on ABC Limited, normal condition 20%, bullish condition 30%, right? And of XYZ Limited, bearish condition 20%, normal condition 30%, bullish condition 40%. So, if this is the scenario of the market and if this is the expected return of the two securities, we have to find out the expected return of the two securities, that is ABC Limited and XYZ Limited, and the risk of the securities of two companies. And it is also being given that if an investor invests rupees 3 lakh in ABC Limited and 2 lakh rupees in the XYZ Limited, what will be the expected return of the investment? Means the investor's investment is 5 lakh rupees. Out of this total investment of 5 lakh rupees, investor has invested 3 lakh in ABC company and 2 lakh in XYZ company, right? So, what is because you are more concerned with the total return. So, you have to calculate what will be the total expected return of the investment of 5 lakh rupees which investor is going to make. Now, let us calculate firstly the return part and the risk part, right? So, return, the probabilities is given of bearish, normal and bullish, right? The expected return in all these three conditions is given, 15%, 20%, 30%, bearish condition 15, normal 20%, bullish 30%, probability of these three conditions is given 0.3, 0.3, 0.4, right? So, the expected return, as you know, probability PI multiplied by RI and the summation of it, right? So, what we have done is 15 multiplied by 0.3, 4.5%, 20% minus, 20% multiplied by 0.3, 6%, 30%, multiplied by 0.4, 30% multiplied by 0.4 comes to be 12%. So make summation of it, 4.5 plus 6 plus 12, that comes to be 22.5. So expected return of ABC Limited is 22.5%. Now, after calculating expected return, you have to calculate the risk associated with the security ABC Limited, right? So for calculating standard risk, we'll apply the formula of standard deviation, because standard deviation is a standard method of calculating risk, right? So standard deviation is equal to summation square root of summation of I is equal to 1 to n pi multiplied by Ri minus R bar whole square, right? So Ri pi we have already calculated. So expected return we have calculated 22.5%. So the first step of calculating risk is Ri minus R bar. That is, Ri is your return which you are getting. So 15% minus 22.5%. That comes to be minus 7.5. 20% minus 22.5%. That comes to be minus 2.5. 30% minus 22.5%. That comes to be 7.5%. So Ri minus R bar, right? The next step is you Pi means the probability of different conditions, bearish, normal, bullish, multiplied by Ri minus R bar whole square. So Ri minus R bar we have already calculated. So 7.5, right, multiplied by the probability and whole square of it. So 7.5 multiplied by 0.3 whole square or square of it, that comes to be 16.875, right? So you can say 2.5 multiplied by 2.5, that is 625. Oh, sorry, 2.5 multiplied by 2.5 multiplied by 0.3, right? So that comes to be 1.875. Similarly, we can calculate for bullish condition, 22.5, right? So you make summation of it. Formula is summation of, right, Pi multiplied by Ri minus R bar whole square. So the summation of this is 41.25 and square root of 41.25 comes to be 6.42. That is, there is a 6.42%. The standard deviation is 6.42, right? So return we have already calculated. So what you was being asked in the question in our example is that find out the return and risk of the two securities. So we have calculated for one security. That is, the standard expected return is 22.5% and the risk is 6.42. Now, in a very similar manner, we will calculate for XYZ, the other securities. The first step is you calculate expected return, same in the very same manner, Ri multiplied by Pi. So 20 multiplied by 0.3, 30 multiplied by 0.3, 40 multiplied by 0.4. That is 6%, 9%, 16%. Summation of it is, right? So that is called 31%. That means the R bar, expected return, R bar is nothing but expected return is 31%. Now the other step of calculating risk, the way we have calculated for ABC Limited, in a very similar manner we will calculate for XYZ Limited. That is Ri minus R bar, that is 20% minus 31%, right? 30% minus 31%, 40% minus 31%, that comes to you minus 11, minus 1, 9, right? So next step is Pi multiplied by Ri minus R bar whole square. So 36.3, 0.3, 32.4 and the summation of it comes to be 69, right? So square root of 69 comes to be 8.31. So this is the risk. As you are seeing, in case of ABC Limited, the risk is 6.42. In case of the XYZ Limited, the risk is 8.31%, right? So in this way, you have calculated the risk and the expected return of the two securities. What you are asked in the question is, apart from these two things, risk and the return, you are said if an investor has invested 5 lakh rupees, 3 lakh in the security ABC Limited and 2 lakh in the XYZ Limited, what is the expected return of the investor? So what we'll do, friends, we'll assign weights. For ABC Limited, the investment is 3 lakh. So 3 lakh divided by 5 lakh, the weight is 60%. 2 lakh divided by 5 lakh, the weight is 40%, right? So whatever the investments which we are making, because an investor is investing in different securities, so what is the weight of each of the security of his investment or of her investment? So accordingly we'll assign weight. That is how you have assigned weight. Simply investment in a particular security divided by the total investment. So 3 lakh divided by 5 lakh, 2 lakh divided by 5 lakh, it comes to be 0.6 of for security ABC Limited and 0.4 of security XYZ Limited. So these are the weights. So expected return, we have already calculated of the two securities. Of security ABC Limited, the expected return is 22.5%. For security XYZ Limited, expected return is 31%. So what I will do is simply I will multiply WIRI, weights multiplied by the return, right? So 0.6 multiplied by 22.5%, that comes to be 13.5%. 0.4, which is the probability, multiplied by 31%, it comes to be 12.4%, right? So 13.5 and 12.4 is the WIRI. WI multiplied by RI, that is weights multiplied by the return, expected return. So we add up these two returns, that is 13.5 plus 12.4, that comes to be 25.9, right? So summation of WIRI is the expected return of the portfolio, I can say. Because what is portfolio? Portfolio means bouquet of the securities which you are having. So an investor is more interested in the whole return, the expected return of the portfolio, right? So expected return we denoted by R bar of P. P means here portfolio. So return of the portfolio, expected return of the portfolio is equal to 25.9%. So these were the three components in this example. First component was calculating the return of the two securities. The second component was calculating the risk of the two securities, which we have calculated by applying standard deviation formula. And the third is that what the calculation of the return of the portfolio, because the portfolio consists of two securities and where different amount of investment is being given. Had the investment been equal in both the securities, I would have simply added up the return and divided by 2, that would give me the average return. But here, since the expected return of two securities is different and the amount of investment is different, so I'll use the weighted average return method, right? So we have calculated the weighted average return, that comes to be 25.9%. Friends, after talking of standard deviation, now I'll be talking of coefficient of variation. Coefficient of variation is also a method of measuring the risk. So measurement of relative variability. There are two securities. I have just talked about ABC Limited, XYZ Limited. There are two securities. You want to know the standard deviation of the two securities is different, the average return is different. So you want to know which security is more risky, because standard deviation is different, the return is different. How will you know which security is more risky, right? So for this we use coefficient of variation. So coefficient of variation is a measure of relative variability. It is the ratio of standard deviation to mean. Means it is the ratio of standard deviation divided by mean. This will give you the coefficient of variation. So it is particularly useful when the investor wants to compare two or more securities having different average return and standard deviation. As I was saying in my previous example also, I talked about two securities, ABC Limited and XYZ Limited. The standard deviation, that is the risk of both the securities, was different. The expected return was different. So the question is, which one will you choose? Whether you will give more focus on the risk element or you will focus more on the return element, right? So how will you calculate it? So for calculating this, we find out the coefficient of variation. So higher the coefficient of variation, greater is the risk, right? So in a case where the standard deviation and expected return is given, so there are basket of securities of investment which you have made. You want to know which is relatively more risky. So higher the coefficient of variation, greater is the risk. So coefficient of variation is equal to standard deviation divided by mean. Mean here means mean return, average return, right? So in this way you can calculate coefficient of variation. Let me explain it with the help of an example. Given the following information about two securities A and B, expected return of the two securities is given. Of security A 14%, security B 17%. And you are also being given the standard deviation of return of the two securities. That is, standard deviation return in terms of percentage of A is 7.5% and of B is 11%. Which security is more risky, right? So in this case, we'll use coefficient of variation. And what is coefficient of variation? Simply how you calculate, how you measure coefficient of variation? Very simple, standard deviation divided by mean. So coefficient of variation of security A is 7.5, right, which is the standard deviation which is given in our example, divided by mean return. Mean return is 14%. So 7.5 divided by 14, that gives you 0.54. Coefficient of security B is, that is standard deviation 11 and the mean return is 17. So 11% divided by 17% or 11 divided by 17, that comes to be 0.65. So I have just talked about this. The security which is having higher coefficient of variation is being considered more risky. So coefficient of variation is a relative measure of calculating risk. So I can say here that security B is riskier as it has a higher coefficient of variation, right? So in this way we can calculate coefficient of variation. So which study should be selected, one investor and why? An investor is considering the following two securities of investment. You are given probability, you are given return of the securities, two securities, 8%, 10%, 12%, the probability is given, return on Y is also given. Which security should be selected by the investor and why, right? Now let's see it. Why we will choose security X or security Y. 8%, 10%, 12%, return of Y is 15, 10, 11, probability is given 0.3, 0.4, 0.3, right? So you have you will be calculating, or what we do in the return and risk of the security X. So we have done enough example on this. So I am quickly going through it. So return in terms of percentage is given 8%, 10%, 12%, probability is given. So simply I have multiplied RI, PI and make the summation of it, that comes to be 10%. Similarly, for calculating standard deviation risk, we'll simply use the formula square root of summation of I is equal to 1 to n PI multiplied by RI minus R bar whole square, right? So we have seen by rough examples earlier also that we have multiplied PI multiplied by RI minus R bar whole square, that comes to be 1.20, 1.2, that comes to be 2.4. So the standard deviation of the security X is 2.4 square root of it. It comes to be 1.55%. Similarly, we will be calculating for in a very similar manner. I am not showing you the calculation part because we have done taken enough example on it. So we have calculated the standard deviation of the security Y. Fine. So it comes to be 2.14%. Now comes the question, which of the security is more risky? As in the previous example I said that the security which is having higher coefficient of variation is being considered more risky. For security X, I will say standard deviation divided by mean, that comes to be 0.16. For security Y, that is the standard deviation divided by the mean, that comes to be 0.18. So I will simply say that security X is less risky than security Y as it has a lower coefficient of variation. Or you can put it other words, you can say security Y is more risky as compared to the security X. So in this way, friends, we can calculate relative risk of the securities, that which security is more risky. Friends, after talking of risk and return and measurement of risk and return, now I will be coming to the tax aspects of return. As all of us know that in India, taxation on different securities is different. Like for example, if you invest in public provident fund, PPF, right, up to 1.5 lakh rupees in a year, your whole of the interest income and the amount which you invest is deductible from tax under section 80C. That is, your taxable income will be reduced by 1,50,000 rupees. Your total income will be reduced by 1,50,000 rupees if you invest in the public provident fund, right, or simply put it, PF fund. So it is not subject to any taxation up to this certain amount of 1.5 lakh rupees under section 80C. The interest element which you get, the investment which you make, right, even at the time of withdrawal, the amount is not taxable. But if you invest in bank fixed deposit, right, the interest which you get on the bank fixed deposit, it is subject to the marginal rate of tax. When I use the word marginal rate of tax, what it means is that the rate tax slab in which you are. Suppose you are in the highest tax bracket, that is 30% in India for individuals. I am not talking of HNIs, right? So you are in the high tax bracket, 30% tax bracket. So your whatever the income, interest income which you will be receiving on your investment, say you have made 10 lakh rupees of worth of investment on bank FDs, right, and it is subject to 5% return on your bank FDs, right. So you will be getting 5% return on your 10 lakh, that comes to be 50,000 rupees per year. So this 50,000 rupees will be added in your income and you will have to pay 30% tax on this investment which you are making. The point I am trying to make is that different investment are subject to different taxation, right. On some investments there is no tax, either no tax or low rate of tax. On certain investment there is a higher tax, means as compared to the other securities. So what an investor is interested is in knowing that what is his post-tax return. That is suppose I get a 1 lakh rupees interest income, and if I am in a 30% tax bracket, so straight away 30,000 rupees will be paid to the tax authorities. I am not taking into account surcharge and all those things, I am taking flat 30%. So my effective income of interest income will be not 1 lakh rupees, my effective post-tax interest income will be 70,000 rupees, right. So as an investor, as a prudent investor, I would say, you should be interested in knowing what is your post-tax return, what is the post-tax yield on any investment. So tax can have a significant impact on the net return available to the investors. Tax treatment and rate of tax differs from investment to investment, which I have already explained. Some investments are tax free, like tax free bonds. Some are tax. I have taken the example of public provident fund, right. Here I have written tax free bonds. Tax free bonds are the bonds which are being issued by the Government of India, and on behalf of the Government of India, it is the RBI which issues tax free bond. So where no tax is being imposed on the interest income which you earn out of it. So some are tax deductible and some are taxable in the hands of the investor. So in order to compare the various investment assets, one must compare the benefit either pre-tax or post-tax. Means what will be I will say post-tax return, right, which you will be getting. So after tax return, or we call it post-tax return, is equal to coupon rate, or you can call it taxable rate, into 1 minus tax rate, right. So taxable equivalent yield is equal to, in case of tax-free investment, we can calculate the tax equivalent yield in order to compare it with a taxable investment. Like I am comparing the return which I am getting from bank FD with the PPF. PPF is giving me, say for example, 7%, or bank FD is giving me 5%, right. So PPF is 7%, is effectively not 7%, more than 7%, because tax equivalent yield will be more than 7%, right. So I will say tax free rate in my example which I have been taking, supposing like say for example PPF, I say tax free rate is 7% and I am in the 30% tax bracket, suppose. So 1 minus tax rate. So 1 minus tax rate, 30% is the tax rate. So 1 minus 0.3, that comes to be 0.7. So 7% divided by 0.7, that will come around 10%, right? So my tax equivalent yield is, means had I comparing it with taxable yield on my investments, right, that is equivalent to 10%. So effective yield on my investment is tax equivalent yield is 10%, right? So let me explain it with the example. Mr. Roshan is earning 15% interest on bonds and his income is subject to 30% rate of tax. Find his after tax rate of return, right? So after tax rate of return is equal to coupon rate. Coupon rate means the nominal rate of return which the investor is expected to get on his investment. Because as you know, on bonds the rate of return remain fixed, that is the issuing authority will year after year give you the coupon rate of return on your par value of your investment on the bond, right? So coupon return is 15%, means if it is a 100 rupee bond, 15 rupees, right? So 15% or 15 rupees into, if the investor Mr. Roshan is in the 30% tax bracket, into 1 minus 0.3, right, that comes to be, so 15 into 0.7, that comes to be 10.5%. Apparently it looks that this is a very attractive investment, the investment will give you 15% return, but what amount will come in the pocket of Mr. Roshan? It is not 15 rupees on a bond of 100 rupee, it will be only 10.5%. So as a prudent investor, you must compare the investment return on the investment, this is post-tax return on the investment. Let me take another example. Mr. X, the income of 14%, the income is subject to the 30% tax free. Find the return on security where he should invest in money to get the desired rate of return of 14%. Means what is interested is, he is interested in after tax return of 14%. So taxable rate into 1 minus tax rate. So 14% is the taxable rate, and if it is in 30% tax rate, 14. So taxable rate 14 divided by 0.7, that is 20% is the return which he should get. Thus the rate of return on the security should be 20% to get an after tax return of 14%. Means I want that Mr. X wants that post tax return he should get 14%. So if it is in 30% tax bracket, and if the investment is subject to 30% tax, right, how much return the Mr. X should expect, so that post tax return is 14%. So 14 divided by 0.7, that is 1 minus 0.3, that is 0.7, that is 20% return he should get in order to get effective return of 14%, right? So friends, in this manner we have seen that how we can calculate that what is the impact of tax on our return, or if an investor wants to know, that is for getting X percentage of after tax return, how much taxable return he should get, so that he can get this post tax return of X percentage. That is, in our example, suppose he is expecting 14%. So if it is in 30% tax bracket, that investor must earn 20% in order to be effective rate of 14%. So thank you very much for today.